Assalamu alaikum and good morning. Students, today we are going to discuss chapter 16, which is allocating cost between in a situation where you may have joint products and byproducts. What do you mean by joint products? So there could be companies which have a particular production process. Maybe they have a production process where they would process their raw materials to convert them into finished products, but at the end of the process, they may have not one product, but they may have multiple products. And if each one of these products are the result of a common production process, then we call these products as joint products. Okay, so we'll talk about what are byproducts. Byproducts are one of the product of the joint production process, which may not have a huge, let's say, sale value, or even if it has a sale value, it may not be the intention of the company to produce it. So intentionally, if the company is starting the process to produce maybe two items, A and B, then A and B are called as joint products, but maybe in the process they also end up producing another item called C, so C would become the byproduct. Okay, so let me illustrate that with this diagram. So imagine this company is processing raw milk, and in the raw milk production industry, what the company would do is it would have some processes, maybe up to here, that it is processing the raw milk, maybe taking up a lot of steps, step 1, step 2, step 3, whatever, they are processing it together. I mean, the whole of raw material would be processed through this production process continuously until it reaches a particular stage, maybe the stage where you can see the dashed line, and at that step they end up with maybe two outputs. Maybe they get cream and they also get some liquid skim milk, right? So this situation shows that the process which was common until this point, when the product became two, is called the joint process. Okay, this dashed line where the where you recognize that now we have two products is called the split off point. Okay, and all this expenses that you did before the split off point is called the joint cost. Okay, and the products that you get after the split off point, so if you can see, product A cream and product B skim milk is called the joint, let's say, products. Okay, now if I had another output, let's say C, okay, maybe something, maybe we call it as whey. Okay, what is whey? Whey is the watery liquid that you may get after you have taken out the cream. Okay, or maybe you have taken out the cheese or whatever. So let's say you also received another product called whey, which was not the intention of the company. The company did not intend to produce whey, but they may be intended to produce cream and liquid skim. So cream and liquid skim would be called the joint products, and whey would be called the byproducts. Okay, so I hope I was able to explain these concepts. We'll be talking about that in the coming slides. So what we talked about is the joint process. This part before the split off point is the joint process. We talked about joint cost, that is anything that you spend before the split off point is the joint cost. And we talked about the joint product, the product which has some sales value, or the product which was produced as intended is called the joint products. And maybe we also talked about byproduct. The byproduct is the product which you got at the end of the unit. And of course we talked about the split off point. It's the point at which you are able to recognize the joint products and the byproducts, right? So let's quickly define each one of them. So joint cost is the cost of a production process that yield multiple products simultaneously. Split off point is that joint or that juncture in the joint production process where you are able to recognize more than one joint outputs. Okay, and then separable cost is any cost that you incur beyond the split off point. That is, okay, let me just go back to my diagram here. So you spend some cost before the split off point and you call it as the joint cost, but you may also spend some amount, or you may also spend some cost after the split off point. But now after the split off point, when you spend something, you know specifically how much you have spent on each product, isn't it? So that is why they are called as separable costs. So separable cost, there is no need to allocate because you know exactly what you have spent on each of the output. But our concern is the joint cost, because can you see, before the split off point you do not know how much of this cost, maybe for example in this case 400,000, you do not know how much of this 400,000 was spent on cream and how much was spent on liquid skim. So that is the purpose of this chapter. We are trying to find the ways or the methods in which this joint cost, that is the cost that you spent before the split off point, uh, to the joint products, that is the output that you got after the split off point. So we want to know how much of this 400 should be allocated to cream and how much of this 400 should be allocated to the liquid skim. Okay, so that's the main point of this chapter, right? So here we talked about separable cost is all the cost that you incurred beyond the split off point, and you can assign it, maybe you can directly assign it to the specific products that you can identify after the split off point. Right, so we'll talk about the concern here. Normally, when we talk about the joint outputs, we find that you can have output with positive sales value, or you may have output with zero sales value. So that's not the matter whether it's positive or zero, doesn't matter. Basically, if you have output with a positive sales value, you can call them as the products. In other words, you can call them as joint products. Right. So what are products? Products are any output with positive sales value or an output that enable the firm to avoid incurring costs. What does that mean? It means the sales value could be high or it could be low, but it has some value. Then you can call them as a product. Right. So having said that, if there is one product with a high sales value and then many other products with low sales value, then that product with high sales value can be called as the main product, right? So main product is the output of a joint production process that yield one product with high sales value as compared to the others. While sometimes what happens, you may not have one product with a high sales value, another product with low sales value. Rather, you may have multiple products which have maybe almost comparable sales value. In that case, maybe all these products, instead of calling one main product and maybe other as products, what you can say is you can call them all as joint products, right? And then what are byproducts? And byproducts are nothing but those products which have very low sales value, like I explained to you earlier. It may have very low sales value, or it could even have zero sales value, or sometimes you can also define it as maybe those products that you produced without any intention. You did not intend to produce them, but it was a result of your production process. Okay. And so with that, let's take some examples of companies which have a joint production process. So you need to understand that this is not an uncommon methodology in cost accounting. You have a lot of industry, you have a lot of companies which actually have a joint cost situation. So which are those? So if you can see in this column under industry, you will see agriculture or food processing industry, extractive industry or natural mining industry, chemical industry, and even the semiconductor industry, or the or we can say the high-tech industry also faces this type of situation. So if we are taking some example under the agricultural industry, maybe cocoa beans food processing company, they make process raw cocoa bean, and then they have some joint products which could be cocoa butter, cocoa powder, cocoa drink, maybe cocoa drink mix, maybe the tanning cream, and so on. In the lambs or the meat industry, you can find cuts, stripes, hide, bone, fat. Maybe in the raw milk, like we saw in the illustration, could be cream, liquid skim, maybe cheese, yogurt, whatever you want to add there. Lumber or wood industry. Here you can have wood or lumber, or maybe we can say cut wood of varying grade and shapes. Maybe in the turkey or chicken industry, you may have breast, wings, thighs, drumstick, and so on, which you could separate at the split off point. Similarly, in the coal industry, you may have coke, gas, benzol, ammonia, and other examples in other industries. Maybe if I'm talking about chemical industry, in the LPG, you may find that butane, ethane, or propane could be the different industry. Maybe in crude oil, you can have gasoline, kerosene, benzene, and so on. So you would notice that this is not an uncommon, or we can say it's not a very special type of uh, what you say cost accounting situation that we lead up to. So you could see this type of costing is done in fairly many different industries. Okay, so having said that, let's talk about how would you allocate the joint cost to the joint products, right? So there are different methods of doing so, but basically before the manager decides to allocate the joint cost to the joint products, they need to understand that the reason why it should be done. So there are four reasons. First one is maybe you want to compute the inventoriable costs or the cost of the goods sold so that you can show it in your accounting or tax reporting. Second reason is that maybe sometimes your company is following a cost plus contract, so you would want to receive a reimbursement of your cost from the company. I think we were discussing this in one of our chapters when we were talking about government contracts. So we want to tell the government that this is the cost that we want to receive back from the product that we have sold, or maybe for regulating the prices, or maybe we want to fix the prices for the different joint products in an appropriate manner. So yes, we want to allocate the joint cost to joint product. And the final reason is that sometimes maybe if the products are lost, or maybe your products get destroyed and you want to claim the cost of your product from an insurance company or through a litigation, then you need to be able to calculate the cost of your product by using appropriate measures which is acceptable by the third parties, right? So with that, let's go to the methodology or the approaches to allocating the joint cost to the joint product. So the first, there are actually two approaches. One is called the market-based approach, and the second one is called the physical measure approach. So physical market-based approach are those approaches which uses the market value or the sales value of your product at the point, at the split off point, or maybe even at the end product output. And the second measure is called the physical measure, where you don't take the market value, rather you take the actual output. You say maybe the output could be measured maybe in numbers, or maybe in kilos, in pounds, in gallons, and barrels, and so on. So you can use that as a basis for distributing the joint cost to the joint product. Right. So market-based approach, there are three methods here. The first method is called sales value at split off. Inshallah, we'll talk about that in the coming slide. Sales value at split off means that you first calculate the value of your output at the split off point if you are going to sell it immediately, and then use that as a basis for distributing the joint cost to the joint products, right? Second method under the market-based approach is net realizable value. What you do is, it is actually similar to the sales value approach, but you don't take the sales value at split off. Rather, you calculate the net realizable value, that is after also considering the separable cost. Okay, we'll talk about this in the coming slide. So first you calculate the net realizable value and then use that calculation as a basis for distributing the joint cost to the joint product. Now the last thing is constant gross margin percentage, that is the NRV, a percentage of the NRV. So this is where you calculate the gross margin percentage, maybe after considering the sales value of the final output, and then calculating the gross margin percentage, and use that as a basis for distributing the joint cost to the joint output. So here we are going to talk about these four methods, and inshallah we'll also do exercises based on these four methods. So moving on, let's take this as an example for all the for the illustration of the four methods. This is also the same illustration which I showed you at the beginning of the chapter. Let's say here is a milk producing company which has a joint cost of $400,000. You understand what is joint cost? Cost that was spent before the split off point. And then they used 110 gallons of raw milk. They started with 110 gallons of raw milk and processed this till the split off point, and the total cost was $400,000, right? So at the end what you receive is two joint products, cream and liquid skim. Okay, so there were no beginning inventory. The total production is 25,000 gallons of cream and 75,000 gallons of liquid skim. The sales out of that, how many were sold? 20,000 were sold of cream and 30,000 were sold of liquid skim. That means you have an ending inventory of 5,000 on cream and 45,000 in liquid skim. Also, the selling price per gallon of cream was $8 per gallon, and then for liquid skim it is $4 per gallon. Okay, so now we have two output, cream and liquid skim. We will call both of them as joint products because both of them have considerable sales value. That is what we are going to take up in the next slides, where we'll talk about how would you allocate this 400,000, that is the joint cost, towards uh, right, sorry, here this 400,000, which is the joint cost, towards the cream and liquid skim. Okay, so how much of this 400,000 will be allocated to the cost of cream, and how much of this 400,000 would be allocated to the cost of liquid skim? So in the coming slide we will be talking about these four methods, that is sales value at split off, NRV method, gross margin percentage method, and the physical measure method. Right, so let's go on. First, we'll talk about the sales value at split off method. So in that case, what we basically do is we calculate the sales value at split off and then calculate the ratio of these sales values, which will be used as a basis to distribute the joint cost, right? So this method uses the sales value of the entire production for the accounting period. It's not just the quantity sold. So in our example, what we need to do is we need to take the total production rather than the total sales. So sales value at split off method follows the benefit received criterion of the cost allocation. So if you can see this table here, this is how you do the calculation for the sales value at split off. So first thing we do is calculate the sales value at split off for both these products. So we take three columns here for the two joint products, cream and liquid skim, and then we take one column for total. So the sales value for the total output, so according to our example, 25,000 gallons of cream was produced and the sale value is 8. So 25,000 into 8 would be 200,000. Similarly, 75,000 gallons of uh, liquid skim was produced at $4 per gallon. So it would be $300,000, right? So add 200 plus 300. So the total sales value is 500,000. Now find the percentage of these two sales value as a percentage of the whole. That means 200,000 divided by 500,000 is 40% or 0.4, right? Similarly, 300,000 divided by 500,000 is 60% or 0.6, right? So use this percentage, 40% and 60%, to distribute this 400,000 for these two products. So 400,000 into 40% is $160,000, and 400,000 into 60% is $240,000. So can you see this 400,000 under the sales value at split off method was distributed as 160,000 towards cream and 240,000 towards the liquid skim. So if we were to calculate the joint production cost per gallon, then I could say 160,000 divided by 25,000 gallons, which was for cream, that is $6.4, and 240,000 divided by 75,000 gallons is $3.2 per unit. Okay, so per unit cost allocated is 6.4 for cream and 3.2 for liquid skim. So if we were to prepare, let's say, the income statement, revenue minus cost of goods sold would give you gross margin. And how would you calculate the gross margin percentage? So let's start there. We would start with the revenue. Now remember, when we talk about revenue, basically revenue is distributed, is calculated by using the number of units sold. So in this example, 20,000 gallons of cream was sold at $8, and 30,000 gallons of liquid skim was sold at $4. So you calculated the sales price, 160,000 and 120,000. So the total revenue received is 280,000. And then you will take cost of goods sold. Remember, you have to take you have to take the joint cost because they have not given you any separable cost. So let's only talk about the joint cost here. So joint cost, which you already calculated, 160 and 240, we are taking it here, 160,000 and 240,000 minus ending inventory. So we deduct the ending inventory, 32,000. So what you got is the cost of goods sold is 128,000 and 96,000. When I say revenue minus cost of goods sold, what I get is gross margin. So 32,000 and 24,000 is the gross margin. and the total of 56,000 is the gross margin for this situation, right? Now what happens, because you have taken the joint production process based on the sales value at split off, you would, and there's only one cost actually, so you can calculate the gross margin, which will be the same for all the products as well as the total. Okay, nothing special about this. This is only because you have only one type of cost. Okay, so nothing, no specific observation required here. Fine, so let's go on to the second method. Let's say the physical measure method. Now, under the physical measure method, what you do is you simply use the physical count of the output, that is the joint output, to decide the weight to distribute the joint cost to the joint product. So let's illustrate that. So under the physical measure method, what you would do is, first thing you would do is take the physical measure of the output. So write down what you have, what output you have got in terms of units. So in this case the unit is gallons, so you have 25,000 gallons of cream and 75,000 gallons of liquid skim. You use that as a basis for distribution, so add up, the total will be 100,000. So 100,000 sorry, 25,000 divided by 100,000 is 25%, and 75,000 divided by 100,000 is 75%. So you use this 25 is to 75 ratio to distribute the joint cost to the joint product. So 400,000 into 25% is 100,000, and 400,000 into 75% is 300,000. You use that as a distribution basis, and per unit cost will remain the same under this approach. Okay. Fine. So with that, let's go on to preparing the income statement. So start with the revenue, the same as before, and then the production cost, the one you calculated, 100 and 300,000, and minus the ending inventory. In this case, you will have 5,000 gallons of ending inventory at 4 per gallon. Now, why did we take 4? Because inventory is always calculated at cost, so this is 4. Okay, so that would be 20,000, and again 45,000 gallons at 4 per dollar is 180,000. So now you got the cost of goods sold, that is 100 minus 20, 300 minus 180, so you got 80,000, and 120,000. Revenue minus cost of goods sold should give you the gross margin. Now in this case, can you see the gross margin percentage would vary? It wouldn't be the same. Again, you don't have to place any observation, because in the real world there will also be separable costs which we have not taken into consideration. But what we can note here is that under the physical measure approach, the joint cost allocation per unit is going to be the same, right? So with that, let's come to the next method, that is NRV, that is net realizable value method. Now under this method, you allocate the joint cost to the joint product during the accounting period by calculating the NRV. Now what is NRV? NRV is calculated like the final sales value minus any separable cost. So here in many cases we know that products which can be processed even beyond the split off point. Now maybe for example, let's say in our example of cream and liquid skim, let's say once the split until the split off point the company has spent $400,000. Let's say beyond the split off point also the company spent some expenses, but now they know specifically how much they have spent for the cream and how much they have spent for the liquid skim, right? So when we want to calculate the NRV, we take the final sales value, we take the final sales value and minus the separable cost for each of the output in order to find the NRV, and then NRV will be used as a basis for calculating the allocation, right? So let's take our example a little bit further. We already know our example until here, right? So we already know that the raw milk was processed, 110 gallons of raw milk was processed by spending $400,000, which we call as the joint cost. And after split off, we have two output, 25,000 gallons of cream and 75,000 gallons of liquid skim. So we'll take our example a little bit further. Let's expand it a little bit further. So what if there were further processing of cream and then you spend 280,000 on the cream to produce buttercream? Maybe 20,000 gallons of buttercream was produced. And maybe the liquid skim was further processed by spending $520,000, and you produced a new output called the condensed milk, and 50,000 gallons of condensed milk was produced. So what if you have a joint cost, as you can see here, 400,000, and also separable cost for product A and for product B, and you end up with producing a new product, two new products, buttercream and condensed milk. So let's take this example and see how we use the NRV method, and also we'll see the gross margin percentage method, the two methods which require separable costs, right? Fine. So let's start with the NRV method. So how would you solve if that information was given? So let's put the information in a table. So what we have now is 400,000 is the joint cost for the two products, that is cream and liquid skim. That was the joint product. However, our final output is not cream and liquid skim. Our final output is buttercream and condensed milk. So now we are more interested to know what will be the allocation of this joint cost towards buttercream, and what will be the allocation of this joint cost towards condensed milk, by taking both the joint cost as well as the separable cost that we saw from the previous diagram. Okay, so here the information could also be laid down here. This information which we already know, 25,000 gallons of cream and liquid skim, 75,000 gallons of liquid skim. And then what they did was they sent this for further process. The whole of cream and liquid skim was sent for further process. They were not sold, so we are not talking about them anymore. We now talk about the items that were sold, so buttercream and condensed milk. So how many units of buttercream was produced? 20,000 gallons of buttercream and 50,000 gallons of condensed milk was produced, and the sales, it was 12,000 gallons were sold and 45,000 gallons were sold. So we have an ending inventory of 8,000 gallons and 5,000 gallons, and also they gave you a selling price $25 per gallon and $22 per gallon. Okay, so with this information, let's discuss two more methods, NRV method and the gross margin percentage method. Okay, so let's go to the NRV method first. So under the NRV method, now we are interested to take our final output, that is buttercream and condensed milk. So first thing we need to do is calculate the NRV. Remember, the formula says NRV is equal to final sales value minus the separable cost. So first let's take the final sales value. So in final sales value, we know that we have 20,000 gallons of buttercream um, that was produced at, and we could sell it for $25 per gallon, and 50,000 gallons of condensed milk was produced, which could be sold for 22,000 gallons. So we take the production units here and then multiply with the sale price. So the sales value would be 500,000 and 100,000, and the total sales value would be 1,600,000 minus the separable cost, as is given, 280 and 520. So what we got is the net realizable value, that is 220,000 and 580,000, and total of 800,000 NRV. Now you're going to use this as a basis for calculating the distribution percentage, right? So you take 220,000 divided by 800,000, give you 0.275 or 27.5%, and 580,000 divided by 800,000. So let me take that. 580,000 divided by 800,000 will give you 0.725 or 72.5 percentage. So you're going to use this percentage to distribute the joint cost among the joint products. So this 400,000 would be distributed 27.5% to buttercream and 72.5% to condensed milk. Okay, so this is the amount of distribution, and we can also calculate per unit. So 110 divided by the number of units produced, 20,000 gallons, so $19.5 per unit. 290 divided by 50,000 gallons, so $16.2 per unit. Fine. So this is how you calculate the total cost. Sorry, I made a small mistake here. Not 110,000. What you need to do is 110,000 is the joint cost, right? So the joint cost plus the separable cost. So that will give you the total cost, right? So you take this 280 plus 110, that will be the total cost divided by the number of units produced. Okay, similarly, you do the same for the butter condensed milk. 290,000 is the joint cost allocated. Add the separable cost, that is 500, the total cost for the production of condensed milk divided by 50,000 gallons. So here you got the cost per unit of buttercream as 19.5 and the cost per unit of condensed milk is 16.2. So please understand that correction, right? So now we have cost per unit. Inshallah, we are going to use this cost per unit in the calculation of ending inventory in the income statement. So let's go to the production preparation of income statement. So we start with the revenue. This time we are going to talk about the actual revenue. So the number of units sold is 12,000 gallons multiplied by the selling price 25. Similarly for the condensed milk, it is 45,000 gallons sold at 22. So this is your revenue figure, 300,000 and 990,000. So the total sales revenue is 1,290,000 minus the cost of goods sold. So in this case, now we have to take two types of cost: joint cost and separable cost. So what is the joint cost? Like we have already calculated above, 110,000 and 290,000 from above. So we take that, and we also add the separable cost which was given in the question, 280,000 and 520,000. So the total cost is 390 and 810 minus the ending inventory. So for the ending inventory, you will take the number of units in inventory, that is 8,000 for buttercream and 5,000 for condensed milk, and multiply it with the cost that you have already found out here per unit, right? So use that, and that will give you the value of your ending inventory. So it's a total cost minus the ending inventory will give you a cost of goods sold. So you calculate the cost of goods sold. Revenue minus the cost of goods sold will give you the gross margin, and then you can calculate the gross margin percentage. How to calculate the gross margin percentage? 66,000 divided by okay, 66,000 plus, why is this 300,000? One second. Gross margin as a percentage of sales. Yeah, I'm so sorry. Yeah, so you will take 66,000 divided by 300,000 into 100, that would be 22,000. And similarly for the second product, it would be 261,000 divided by 990,000 into 100, that would be 26.4%. And the gross margin percentage is 327,000 by 1,290,000 into 100, and that would be 25.3%. So this is how you will calculate the gross margin percentage. So let me move on to the last method, that is the constant gross margin method. Now basically this method you actually go backward. First thing you need to do is calculate the gross margin percentage, and then you will allocate the cost. Okay, so constant gross margin percentage NRV method, it allocates the joint cost of joint products during the accounting period in such a way that each individual products gets the identical gross margin percentage. So let's see how it is done. First you need to do is calculate the residual value by subtracting the separable cost from the gross margin from the final sales value. So you start actually backward. In the first step, what you do is calculate the overall gross margin percentage for the total company, including all the joint products, and then compute the total production cost for each of the product and use that to compute the allocated joint cost. Right. So first step, if you can see here, what we do is we want to calculate the gross margin, that's the total gross margin. So first what we do is first calculate the final sales value of all the product during the accounting period. So you know you have two outputs, you have butter cream and you have the condensed milk. So 20,000 gallons into 25 plus 50,000 gallons into 22. So the total sale value is 1,600,000, and minus the separable cost. As we saw before, you take 1,200,000. How did you get that? You just take the separable cost and add them up. Okay, I'm sorry, you take up you take the total cost, that is the joint cost 400,000, and the separable cost 280 plus 520,000, that would be 1,200,000. So now what you are left with is the gross margin. So the total sales value minus the total cost will give you the gross margin. Now calculate the gross margin percentage. So you say 400,000 divided by 1,600,000. So this is the gross margin. 400,000 divided by 1,600,000 into 100 will give you the gross margin percentage, which is 25%. Right? So we are going to use this 25% as a distribution basis for distributing the what do you say, uh, the joint cost of the joint product. So in the second step, what you're basically doing is you're trying to find out the distribution of the joint cost. So let's start off separately for each item. So now you talk about buttercream, you talk about condensed milk, and you have a column for the total, right? So here what you do is first is take the final sales value like we did before. Instead of putting them together, now we put them separately. 500,000, that is 20,000 gallons into $25, and then you have 50,000 gallons into $22, and then add them up, 1,600,000, which is the same that we did here, right? And then minus the gross margin percentage. So what you need to do is take this as a, I mean, 25% of the total, we can say the total would be the gross margin, right? So 500,000 into 25% would be taken here as the gross margin percentage, and 25% of 110,000 would be taken here, and of course total would be 400,000. When you minus that, what you got is your total production cost. Now you have to remember that this is the cost which includes both the joint cost as well as the separable cost. So now what you need to do is minus the separable cost, then you will be having the joint cost, right? So this was given, the separable cost is 280,000, separable cost is 520,000. So you minus that, and now you receive the joint cost. So notice that under the gross margin percentage method, you don't actually calculate the joint cost as a percentage of something, but rather you go backward and first you calculate the gross margin, remove the gross margin from the total sales value, and then you get the total cost. From the total cost, remove the separable cost, and you are left with the joint cost. Okay, so the joint cost allocatable to buttercream is 95,000, and the joint cost allocatable to condensed milk is 305,000. That is how this total 400,000 was distributed. Fine. So let's use that in our income statement. So let's prepare the income statement. Revenue, like before, 300,000 and 990,000. So 1,290,000 less the cost of goods sold. Now we know the joint cost, which we just calculated here, 95,000 and 305,000. Separable cost 280,000 and 520,000. So we got the total cost 375 and 825. Of course, it is the same that we did here on the top, is the same as that. Anyways, now we have to minus the ending inventory. So minus the ending inventory at the cost per unit. So how do we calculate the cost per unit? That is $375 dollars. That is the total cost of production, isn't it? Divided by 20,000 units, and $825,000 divided by 20, multiplied by the number of units in stock, right? So we can use that. So we got 18.75 for the first product, that is butter cream. So 18.75 multiplied by the number of units in stock, that is 8,000, would be 150,000, and then 16.5 multiplied by the number of units in stock, that is 5,000, you got 82,500. So you take the total cost minus the ending inventory will give you the cost of goods sold. So 225,000 and 742,000. Minus this from the revenue, and you got your gross margin 75,000 and 247,500, and that this and also simultaneously calculate the total values. Notice that if you calculate the gross margin percentage, you have to get 25,000 because that was the whole point in this particular method. Okay, so once again, very quickly, under the gross margin percentage method, what you do is you follow a three-step process. In the first step, you calculate the overall gross margin percentage. So once you get that percentage, you will use that for calculating the total cost of the product by by deducting the gross margin from the sales value by using that percentage, and then you found the total cost minus the separable cost to get the joint cost allocation. Right? So this was our four methods for allocation. Now the question is, which method shall we choose? Right? So no, there is no such hard and fast rule as to which method you want to choose. It depends on the information that is available. Suppose you do not know the selling price at the split off point, but you know the final price at which you want to sell. So maybe you may not use the sales value at split off measure. So then what you would use is, maybe you will use the best measure of benefit received. So you need to find what is the benefit that each product has derived from the production process. So to understand the benefit, either you can take the selling price, or maybe you can consider some other values. And sometimes you may want to consider the allocation of the joint process cost to the joint products independent of any further processing. So you don't want to consider whether the process was done further or not, or sometimes you, so that could be a criteria to decide which method to use. Or sometimes maybe you want to use a common allocation basis, maybe the revenue or the final sales value, or you can use that as a basis for distributing the joint cost to the joint process. And of course, sometimes you don't want the method to be very complicated, so you may also prefer to have simplicity while you want to decide which method to use for your further processing. So, but if you do not know the selling price, then the best method will be the NRV method, because here you don't need to know the selling price. You can simply calculate the what is it, the sales value at split off, right? So, but sometimes, some companies, they decide not to distribute the joint cost to the joint products at all. They simply keep the joint cost separate from the joint production processes. Right, so now we'll also consider why it is necessary to allocate the joint cost to the joint product. Now, for the first decision that we need to consider is whether you want to sell or further process. This will be a big decision if we want to decide about it. Okay, so normally we decide whether you want to further process by looking at relevant costs. So relevant costs are those costs which actually impact your decisions. So this concept of relevant cost can also be applied to decision whether you want to process the product further or not. Now, this I can explain with an example. Remember, our example of the milk. We added separable cost by saying that is this raw materials which had two joint product, that was raw milk and liquid skim, was further processed to produce buttermilk as a butter cream, and what was that, condensed milk, right? So when we know that this could be further processed, whether we have to process it or should we just sell it as cream and liquid skim. So that is an important decision for any company to make, right? So in the sell or process further decision, joint costs become irrelevant because you have already expensed it. So some companies decide that, okay, it doesn't matter whether we allocate the joint cost or we not. So we say joint cost can be also called as sunk cost because they have already been spent, and sometimes you don't assume that all separable cost can be incremental in any ways, because sometimes separable costs can also be fixed. So if separable costs are, then again they also become a sunk cost, but you need to evaluate them individually. Okay, now there are some other issues which we can discuss here. The first one is that in the decision making, whether the manager decides to sell the products without further process may not be the only thing that you are actually taking into consideration when you evaluate the maybe the performance of your manager. So as a company, we need to be wary of taking total cost or the full cost of the joint product for making a pricing decision, because sometimes there may not be a cause and effect relationship. Now, what does that mean? It means that if the manager has decided to further process and then sell the product at a higher price, it may not be because of the further process, but maybe if they would have made better benefit by not processing the goods further at all. Right, so let's come to the last part. We talk about byproducts. For the byproducts, there are two methods which you can use for distributing the uh, joint cost to the byproducts. Now, most of the time, or let's say many companies do not allocate the joint cost to the byproducts. However, if they have decided to do so, then they use two methods. One is called the production method, the second one is called the sales method. Production method is you recognize the byproduct as an inventory. So as soon as you have some byproduct, you need to put it in your books of account, and when it is sold, you will consider it as maybe sales and then take out any profit that you made from the sale of such byproducts. Or the second method is the sales method. In this method, when you produce the byproduct, you do not take it as inventory. You simply let it be, and only when you sell it, you consider it as a byproduct. Now, what is the difference between the product method and the sales method? And under the product method, you need to keep an inventory of the byproduct. I mean, you count it like a real product. While in the sales method, you don't keep any inventory. You don't track the inventory of the byproduct. Now, which method a company uses actually depends on the value of the byproduct. If the byproduct is having a very small value, the company do not track it. They just follow the sales method. While if the value of the byproduct is high, they may use the production method. Okay, so let's take this example of a timber company. Let's say they have a joint cost of 250,000 and some processing took place. At a split of point, they have two products. One is a fine grade lumber, which is your main product, and then you received a wood chip, which could be a byproduct. Now, I want you to have a look at the way in which the diagrams are being prepared. So you use different shapes to represent different things. For example, you use a triangle to represent the processes, maybe an oval to represent the finished product, which is a main product or maybe a product, and then maybe you use a rhombus to indicate the byproduct. Okay, so and you use arrow marks to indicate other things. We have exercises where you will be asked to prepare maybe the diagram to illustrate the joint production process. Fine, so in this case you have a byproduct wood chip of 4,000 cubic feet. So if we are to prepare an income statement using this two methods, if we were to use the production method, remember in the production method you are counting the inventory, and in the sales method you only consider when you actually sell it. So in the case of by production method, let's say you have not sold it yet, so you have 240,000 from the sale of main product. There is no sale of byproduct. However, in the case of sales method, you still consider it at the production itself. So maybe if you consider $1 per square feet, so you have 1,200 square feet of wood chips that was produced. So this is how you will be calculating it. Consider the cost of goods sold. In this case, note that you are going to deduct the revenue byproduct revenue. Um, because you are considering it as a ending inventory. So you add the cost, manufacturing cost minus the ending inventory of the byproduct, and then you will also consider the inventory of the main product. So that would give you the cost of goods sold and the gross margin. So that is the difference between these two methods. In the sales method, you consider it only when the item is being sold, while in the production method, you consider it as an inventory also. So which method is better? So again, it is depending on the companies. The production method is consistent with the matching principle. So especially if the byproduct is uh, sufficiently large, then it's better to follow the production approach, because then you can recognize the byproduct inventory and put it in your accounting records, which when it is produced, and then also it will reduce the cost of manufacturing your main product, which is quite logical, especially when the byproduct is large. Sales method is simpler, but then it's possible that the managers may manage the report earning by timing the sales of the byproduct. So this could be quite serious. Okay, with that, we end this chapter, and I just wanted to mention that these are the exercises which we need to complete, 16-16, 18, 20, 21, and 22 for this chapter. So I hope you have understood the chapter, and I look forward to interacting with you today during the meeting and also on Tuesday. Please come forward if you have any questions, and enjoy your time. Thank you.